Okay, good morning, afternoon, or evening to all who've joined us today. From me and the FP Markets team, thanks so much for taking the time out of your day to be with us. Guys, before I begin, if you'd be so kind as to let me know whether I'm coming across loud and clear and the welcome slide is visible, that'd be great. Just go ahead and respond in the chat box and we'll get things underway. All good, thank you guys. Brilliant, thanks guys. So now before kicking things off, I'm assuming most here are familiar with price charts and their organization. So what I mean by this is the general framework of a chart, such as the X and Y axes and the basic functions a chart offers. So also I'm hoping that most here have a basic understanding of support and resistance. So if not, I encourage you to watch our previous presentations, which cover this in detail. These can be found under the FP Markets YouTube channel and also on the FP Markets website under the Education tab through Trading Resources. Excuse me. Okay, so ultimately this webinar is, it's designed for beginners with a specific focus on price action. Now, price action trading is a discipline that involves, making trading decisions from a stripped down or naked price chart. It's evolved into it's a major form of analysis and attracts, many traders due to its relative simplicity. Just to be clear, though, this presentation is designed for beginners. So any experienced hands here, this is unlikely to be anything new. As usual, for any of us here wanting a recording of the presentation, this will be available on FPM's website or on FPM's YouTube channel. Support also sends out an email with after the webinar ends with directions regarding a recording. Alan, is there a screen to view? Yes, there should be. You should be seeing the welcome slide, which says Introduction to Price Action. Okay, so so guys, just let me briefly run over the disclaimer on screen before moving forward. So, information presented in this presentation is intended for general advice only, and none of it should be relied upon as personal advice. FP Markets do not take into account your investment objectives, financial situation, or particular needs. So really then, what we discuss in this webinar should not be considered as investment advice. So although I see some regular faces here, which is fantastic, for those new to our webinars, I'll just quickly go over who I am and briefly introduce the topics of focus for this presentation. So my name's Aaron Hill and I'm part of the research team here at FP Markets. So along with my colleagues, we'll be conducting regular webinars going forward. And for any who are interested, I also post a daily analysis in the Traders Hub on the FPM website, which focuses on price action and multi-timeframe analysis. Also, traders, do check out our daily fundamental analysis and our other technical analysis, Gary Burton, who analyzes a number of markets using price action techniques. Now, for me personally, I've been involved in the financial markets since about 2010, and in terms of credentials, I've completed CMT levels 1 and 2 and enrolled on level 3 this year. I also recently received the CFTE qualification in 2020 from IFTA. Although these proved useful, none of these certificates are really required to become a trader. They just help highlight how broad the world of technical analysis really is. So as for trading, I adopt concepts such as price action, Fibonacci, the relative strength index or RSI, and chart psychology. The latter is, is an in-depth subject, and what most interests me about price action. These are subjects we'll hopefully dive into in future webinars. Listen, guys, at any time you want to fire over any questions, please feel free. The team are here to help. If I miss any questions or you want to make a suggestion, please fire them over to marketanalyst@fpmarkets.com, and the research team will reply as soon as possible. So I just see some questions coming through. Just give me a second, guys. Okay. Is there an e-certificate available for this presentation? No, I don't believe there is, no. Jelena? No, there's not. Okay, so the session's objectives are to define price action. Here we'll be simply defining what price action is and how most view this vehicle of analysis. We'll also be looking at identifying ranging and trending markets. For those, with any experience in price action trading, you'll already likely understand most of what I show in this section, though I consider it 101 stuff and needs to be understood before moving on to more advanced concepts. So we all started somewhere, and this stuff is very basic, but needs to be understood to build on your understanding. So okay, we'll be moving on to candlestick analysis. Now, candlestick analysis is something we touched on in, I believe it was our introduction to technical analysis. There we looked at two basic candlestick configurations. Here we'll revisit those patterns and look at when some traders may consider these trading opportunities. We'll also highlight a couple more candlestick patterns to be mindful of. So multi-time frame price action analysis is the final segment. So multi-time frame price action analysis is an interesting one. Regulars here may remember we briefly looked at this concept during the support and resistance webinar, looking at how we can apply support and resistance levels to multiple time frames to design, some sort of framework or direction, if you will. So I often look at the market from a top-down approach, which is something we'll cover in this presentation. Okay, so to define price action, we really don't need to be fancy. Price action is simply the movement of price, right? This could be the price movement of a currency pair when you're trading Forex, a stock, a bond, or a cryptocurrency. It really doesn't matter. The point is we're looking at the instrument's price movement plotted over time. I've been involved in technical analysis for more than a decade now, and from my experience, I believe price action trading to be one of the more superior systems of analyzing the market, as the majority of technical indicators are calculated based off price action. It's a derivative of price action, if you will. Of course, guys, this is not to cloud technical indicators, as they certainly have use. In fact, I know a number of traders that actually combine price action and technical indicators to form trading strategies. And this is what I use in my daily analysis as well. So put simply, price action looks at the price changes in both liquid and illiquid markets. So really, anything that's bought or sold in a free market will, generate price action. So price action trading, which falls under the umbrella of technical analysis, primarily looks at a market's price history. That is to say, its price movement across a period of time. So in other words, price action trading is, for me anyway, a pure form of technical analysis. So on the slide, I assume you can see this slide. So on the slide, we have a euro-pound daily chart. This is a naked chart with no indicators or technical drawings applied. So this is price action, ladies and gents, what you're seeing here. And it is something, you know, I'm obsessed with. The psychology of a chart has always fascinated me to this day, with the stories it shows regarding where traders commonly buy and sell and place their stops. And this is something I believe, I know in fact, more experienced traders unfortunately look to take advantage of. This is something I'll try to touch on in more intermediate webinars and possibly advanced webinars as well. So look, just spin the slide over. So look, with price action, let's chuck in out the Bitcoin's daily chart. So the question I wanted to ask here is, would you be able to tell the difference between Bitcoin and the euro-pound chart if we removed the X and Y axes and covered the symbol labels? Not only would this be impossible, you would be unable to tell which time frame the price action represents. These charts, these charts here, ignoring this small section here and the dates below it, they could just as easily be a 5-minute time frame, right? But actually they're from the daily chart. So really the general idea is that price action is pretty much the same for each market. It is what we can do with this price action that fascinates me and many other traders across the globe. Let me just switch things over. So identifying ranging and trending markets. For those with experience in price action trading, you'll already likely understand this part of the presentation, as it's essentially 101 stuff. But for newer traders, this must be understood. In our previous technical analysis webinar, we introduced the concept of trend. So for those who did not watch the TA presentation, I'll quickly run over the basics of what we looked at. So we're all on the same page. On the slide, we have what's known as an uptrend or a trending market. This consists of higher highs and higher lows. It's a relatively simple configuration and reveals that buyers are essentially in the driving seat. The next slide is simply the reverse of an uptrend. So this is a downtrend formed by lower lows and lower highs. Now, most of us have probably heard the old adage, the trend is your friend. And as I highlighted in the previous presentation, it really is true. And I emphasize the word if here, you manage to time the trend correctly and have the patience and risk management to ride the trend out. So if you manage to enter near the beginning of a move, which is difficult, and are able to capture a large portion of the trend, this is where you make your money. Enough to cover the losses and bring you into the green. But how many of us are actually capable of riding the trend? This may seem easy. You just simply ride the waves out, right? The ebbs and flows of the market. But it's not as easy as that. So what I'm trying to refer to here is fear and greed. So these are two drivers that affect our daily lives and which carry over to our trading. Actually, fear and greed are often identified as the main drivers of markets. So fear is often observed in situations such as reluctance to enter a trade or even the closing of a winning trade. We also have something called revenge trading, which is where a trader attempts to win back losses by entering, larger, and unfortunately often riskier trades. This is this type of trading is driven by fear and, for me, frustration, and is a vicious cycle, and it can have devastating consequences. So I personally have experience with this and struggled with this in my trading. You have a loss, and then another loss, and then another loss, and it's unfortunately human to want that back, right? To repair the damage and make yourself feel better. Greed may be the fear of missing out. Exactly, Ivan. Thank you. Greed may be the fear of missing out as well. So we're going to move on to greed now. So greed, is, for me, situations when traders add more capital to winning trades or over leverage. So let me just be clear here. This is fine if your system allows for this and has been tested, but if not, you're simply adding to positions on a whim, which can end very, very, very badly. So I hope you guys understand what I mean here, and apologies for deviating here slightly, and also if I've confused newer traders. So the basic idea here is to understand trending price structure and recognize basic higher highs and lows represent a trending market, and lower highs and lower lows represent a downtrend. So let me just spin things over. So yeah, look, not only can we use price action to decipher trend, we also use it to determine trading ranges, or more commonly referred to as consolidations. This is one of the simplest chart patterns, and I believe it's easily recognizable, formed by support and resistance levels. In order to qualify a trading range, traditionally we look for price to at least touch the same price reversal at least twice, similar to if you're looking at trend lines. So as you can see, price action is bounded by the two limits until price action breaks out in either direction. Actually, breakout trading is, it's a common approach around ranges, especially those that formed in trending environments. I believe these are also called flags as well in trending environments. Traders often trade breakouts in the direction of the prevailing trend. Okay, so as false and premature breakouts are common within consolidations, traders often wait for price to close above or below the range and retest the breached boundary, as shown on the slide for a bullish break and retest. This can obviously be said also for a bearish break and retest. It's exactly the same thing. So this is one of the filters, if you will, that breakout traders use to avoid being whipsawed out of a position. And you can imagine how revenge trading could become a part of this. If you enter on a breakout here, you get whipsawed back in, price whipsaws back into the range, catches. These are actually called bull traps. So for instance, the bulls jump in here and they're trapped, right? So price, you expect price to continue rallying higher, but it just whipsaws back into the range. And it also catches, this is not only a bull trap which catches breakout buyers, this is also a move that catches sellers attempting to fade the range here. So they normally have their stops set above here, right? And when price whipsaws above it, it takes them out as well. So it's a massive move here that's really interesting from a price action perspective. Okay, so drawn examples rarely, represent real life trading. So on the slide, we have a chart of the pound against the US dollar on the daily time frame, which shows the market in trending higher in the form of higher highs, higher lows, higher highs, higher lows, higher highs, and higher lows. This is a market that's in a defined uptrend. The dollar CAD chart shown here, on the other hand, demonstrates a clear downtrend formed by way of lower lows and lower highs. So for me, both the pound dollar and dollar CAD are relatively clear examples of trending markets right now. And finally, here's a H4 chart of the euro dollar, showing what I believe to be a ranging market. You will note the range on the price chart compared to our pre-drawn example earlier are similar but not exact. It's rare to see a range formed to the pip, as our pre-drawn example shows. There are always going to be whipsaws, but as long as it's relatively obvious, a range can be drawn, in my opinion. So let's just quickly spin things over to candlesticks. So candlestick analysis. This is something we touched on in, I believe it was our introduction to technical analysis. There we looked at two basic candlestick configurations, the hammer and the shooting star. The hammer is considered a bullish signal formed by a long lower shadow and a real candle body that closes near the upper range. Also, it's vital to recognize that we like to see little to no upper shadow form here. We must also, for me anyway, I believe the candle body color is irrelevant in the formation of these candles. In terms of entry, using these candlestick configurations, traders often employ what's known as buy stop orders for hammer patterns. So a buy stop order is used to buy at a price above the market, and it's triggered when price touches or goes through the buy stop price. This is similar to a protective stop loss order, which for a hammer is placed under the lower shadow. So the stop loss order is in place to prevent additional losses if price goes against you. If you're in a position, if you're in a long position, it's a sell stop order. If you're in a short position, it's a buy stop order. Look, I hope this is clear, guys. So everything we just highlighted is the same so everything we've highlighted here for the hammer pattern is exactly the same for a shooting star, but the only difference is it's reversed and therefore represents a bearish signal. So just to be clear, the hammer and shooting star are not the only candlestick formations traders employ. In fact, there's so many. There really is. So the hammer and shooting star candle represents individual candlestick configurations. Though we have, we've also got candlestick patterns that require two candlesticks to form, like the bullish and bearish engulfing patterns. We also have those candlestick patterns that require three candles to identify a pattern, like the morning and evening star, with the latter being a bullish variation and the former a bearish vision. So it's also worth pointing out that the majority of candlestick patterns traders use are reversal configurations, best found at peaks and troughs, or highs and low points, such as the hammer and shooting star examples on the slide. So of course, it's beyond the scope to go into detail about each candlestick's framework, though, if you're interested in learning more about this, please, feel free to check out our educational section on the FP Markets website, which has plenty of articles detailing candlestick patterns, or you could even check out Steve Neeson's book on candlestick analysis, said to be the gentleman behind bringing Japanese candlestick analysis to the Western world. Candlesticks are said to have originated from Japanese rice merchants and traders to track market prices and daily momentum hundreds of years ago, before becoming popular in the US. So how we use these? So now we have a basic understanding of what the hammer and shooting star is and how traders commonly enter and exit the market. Is how we use these candlestick patterns that I find interesting. So I rarely see traders use them in isolation. What I mean by that is simply trading the hammer pattern on its own with nothing else supporting the trade. So instead, I often see traders use these candlestick patterns as confirmation. In other words, to confirm support and resistance, for example. So yeah, just spin that over. So to help demonstrate this, I've zoomed in to the H4 chart on the euro dollar used earlier to highlight a range. So here we see a number of candlestick patterns in play. So kicking off from the top, you'll note I marked a Quasimodo resistance level. For those unsure of what a QM level is, please feel free to watch my previous webinar on support and resistance. I gave a brief introduction as to what that is there. So the Quasimodo resistance itself, as you can see, failed to deliver much bearish flow before seeding ground. The level was beautifully retested as support, a move which formed a hammer pattern, which, if you remember, is a bullish signal. Now, guys, I have to underline two things here. Firstly, the QM was not officially breached until the extreme of the pattern was taken out, which is here. So given this, trading the retest at this point here, it would have been difficult for me. The second point, of course, is the hammer pattern's structure. Yes, we formed a lower shadow, twice the size of the candle's real body, but the upper shadow was a little larger than I would have liked. So, for me, I would label this as, a half-hearted hammer pattern. Despite this, though, the hammer pattern still formed a notable bullish signal. So lower on the curve, turning our attention to range extremes. Oh, 1 second, didn't mean to press that. Yeah, so the range extremes, we can see that a shooting star candle formed here. Again, we had a little bit of a lower shadow form here, which I'm not too keen on. And we also had a hammer pattern form around here. Another point on the chart worth noting, and this sort of falls back on the previous SR webinar, which I did, which I explained that once a resistance level is breached, we often see price retest the level as support. So let me just spin this around. So what we saw here, we often see price retest the level as support, right? So a broken resistance is often retested as support. The formation of a hammer pattern within a support zone here, it adds so much more confirmation for me. Remember, SR levels are usually best defined as zones, not defined as defined price levels. So as you can see, we've used the candlestick pattern as a means of helping to confirm bullish interest within the support zone here. Now, just to be clear, this is no means, although the trade worked out fantastically, this is by no means a guarantee a trade will work out favorably. It simply, it just nudges the odds in your favor. Yeah, so, and also, I mean, it also depends on how, for this trade, it also depends on how you managed your trade. If you trailed behind the swings, I mean, this would have turned into a whopper of a trade, an absolute whopper of a trade. And this is, it's quite basic in my opinion. You just look for a resistance break and a retest as support, and then have the patience to wait for a defined candlestick pattern to form. And also, guys, I want to highlight something here. If you have the choice here, of course, you could enter based on the hammer pattern, which is the buy stop above the high of the candle, and position the stop below the lower shadow. But for me personally, I would look to enter on the bullish candlestick pattern as a buy stop, and you know, being quite conservative, I would look to place my stop below the actual support. Some traders take it even a little further and look for additional structure below here to place the stop. I mean, this is fine if you're looking for a big move, but if you're looking for a small intraday move up to say here, you know, you have to consider your risk reward. Okay. So now we're moving on to the final part of the presentation, namely multi-time frame price action analysis. Okay. So as I said at the beginning of the webinar, multi-time frame analysis is an interesting one, and regulars will likely remember me touching on this concept during the support and resistance webinar. Multi-time frame analysis for me, it follows a top-down approach and allows traders to gauge the longer-term trend while spotting ideal entries on a lower time frame chart. So it's the process of viewing the same currency. So yeah, it's the process of viewing the same currency pair, assuming we're trading FX under different time frames. Usually, the larger time frame is used to establish a longer term trend, while a shorter time frame is used to spot entries into the market. So the rule of thumb is said to use a ratio of 1 to 4 for the time frames. The reason behind this is to be able to uncover smaller movements in price for well-timed entries that are ultimately in line with the bigger picture. So if you're viewing the H1 chart for trend direction as, say, a short-term trader, you might choose the 15-minute time frame to hone in on entries. This is a 1 to 4 ratio. However, this is not set in stone, guys, so you can use whichever time frame you feel comfortable with and has proven to give you a trading edge. For me personally, I use the monthly and daily time frames to determine longer-term flow. So if I were to use the 1 to 4 ratio, I would of course look at the weekly time frame, but I found that I'm more comfortable with the daily time frame and monthly scale. For shorter term action, I prefer the H4 and H1 time frames, which of course does merge with the 1 to 4 ratio. Well, now guys, if you want, we can switch things over to the daily analysis, which focuses on multi-time frame analysis, and I can run over some fresh examples of how I look at breaking down the market from a top-down approach, or we can shoot straight to questions. I must be clear here though, that the analysis includes other technical tools and technical indicators, which I will have to mention. So guys, if you prefer me to switch over to the analysis, I can happily do that. We can go over a few examples. Just let me know in the chat box, just ping over yes or no, or okay, excellent, thanks. All right, brilliant, guys. Let me just get that set up. There we go. So, so I assume you guys can also see my euro-dollar chart here. As you can see, I don't just use support and resistance. I use supply and demand. I use the RSI indicator. I also use Fibonacci areas, and I also obviously use the Quasimodo support and resistances. So this is the. Let me just make this chart a little bit bigger. No worries, Alan. I'll go over that in a minute for the fibs. No problem. This is actually a difficult one, Alan. I found that so many websites have different ways of defining so a projection, an extension, and you know, the retracement's pretty easy. It's the extensions and the projections that often confuse people. No problem, I'll go over that in a minute. Right, okay, so on the euro, let me just make this chart a little bit bigger. Okay, okay, so here we have the euro dollar. So we have the monthly, daily, oops, just move that, and the H4 and H1 time frame. So look, on the monthly time frame, this is a real longer term time frame, as we all know. So any move here it should be noted. So as we can see, price has spent nearly the last 3 months retracing from 2021 highs, and we're now testing an area of demand at 1857, 1352. In terms of trend, for me personally, the primary trend has been in place since we broke this high here. We've pulled back, we've formed a retracement, and now we're on our way to possibly forming fresh peaks. So onto the daily. So let me just clarify this. So on the monthly time frame, we are testing demand. So when we're testing a monthly time frame demand, we should pay attention, right? This could generate a huge up move, especially on the lower time frames. So knowing this, we spin things over to the daily time frame. So the US dollar lately has been rallying, right? Elevated on higher US Treasury yields. So consequently, this has elbowed the euro dollar through support at 1887, and it unearthed a Fibonacci, a 127.2% fib projection at 1843, along with a 100% fib extension. Now, the 100% fib extension also aligns with what's known as an AB equals CD pattern. For any harmonic traders here, you'll know what I'm talking about. But for any newer traders, this is something I would also recommend you checking out, because harmonics are very good, especially when combined with support and resistance and other technical structure such as that. So also technical elements show the 200-day simple moving average hovering nearby, and that's currently at the 1816 region. So in response to recent selling, we've also had the RSI dip a toe in oversold territory, and when this happens, we can, I have to be careful what I say here, we can expect price to potentially rebound, right? Because momentum's showing it's drove into oversold conditions. So across on the H4 time frame, technical dish. Let me just see. So across on the H4 time frame, we have a quasi-moderate support at 1818, a 161.8%. I believe this is a Fibonacci projection, and a 100% Fibonacci extension at 1860. Now, what I did was I formed a support zone here with these three components, and you know, it aligns beautifully with the fibs on the daily scale and also with the monthly timeframes demand. So we have 3 timeframes here essentially aligning. So with that, you'll know, if you check out my analysis for today, you'll note that I said that I said the following. So the upper side of monthly demand at 1857 here, and alongside the fib supports on the daily time frame around 1845, and H4 time frame also throwing 1818, 1860 into the pot as support, could have buyers retaliate today. I stated this in the previous analysis. So with that, traders may monitor the lower time frame price action within 1818, 1816. So with this, we can see 1850 support help, well, albeit after a minor whipsaw in early trade this morning, in early Asia. We come back up, we retested the, I believe we retested the, no, we didn't, we just missed it. We just scraped the top edge of the 1850 level, and then we broke supply. Now, this supply is, you know, it's, for people not paying attention to multi-time frame analysis, clearly traders wanted to sell here, we can see that. But what they're doing is they're selling into clear higher time frame support, right? In a market that's been trending higher since, you know, since we can see it, since the, you know, COVID-19 hit the economy in March 2020. we've been trending higher on the euro. So this, along with bullish divergence seen on the RSI indicator, it indicated to me that we were heading higher. We were likely going to take out this supply and reach 19. Reach at least the 1900. So look, guys, if we break this 1900 level, we could potentially even reach for the 1950 region, or the supply sitting around that area at 1964, 1951. Now, guys, this is only my personal opinion, so please do take it as such. Okay, any questions on this, guys? Oh, Alan, I'll quickly show you how I draw Fibonacci. Let me just try and find a clean chart. 1 second. Okay, so for me, guys, this is how I draw Fibonacci. So, Alan, I assume you understand the Fibonacci retracement. So that's the basic price retracement here. So we find a swing low, swing high, and we monitor the retracements coming down on the price retracement. Okay, that's pretty simple. I'm pretty sure you know that one. It's the extensions that can cause a problem for some people. Let me just a second. So for me personally, the extension is the measurement between this wave here and this wave here. So we have a 100% projection of the of this swing here, with this retracement calculated in. So we have a 100% extension. So this is measured from A to B to C. But for the Fibonacci projection, we're actually only projecting this wave here. Sorry, this, oh God, this, 1 second, guys. So for the projection, we're only projecting this wave here. All right, we don't include this retracement here. So you can actually, this price action doesn't even have to form before you put the projection on. So for here, you would be looking at, so I normally focus on the 127.2% projection and the 161.8% projections. I don't focus really on anything else. But yeah, so that's basically it. The projection is just from A to B, but the Fibonacci extension is from A to B to C. I don't think there's any need to go into any more detail with that, unless, Alan, is that clear for you, mate? Well, if you'd like me to go over a few more examples, I can show you on the charts that we just looked at. Oh, brilliant. Okay. So look, we can see it here. Look, we have the 127.2% projection, which is measured from A to B. And we also have the 100%, I should have just used this as an example. We have the A, B, and C, which forms the 100% projection. Okay, guys, it is now, do I have any questions about the charts I just showed? I'm sorry if I've confused any newer traders here. I do know this can be quite overwhelming, especially when this is only an introduction on price action. I just thought I'd give you a little taste of how some of us analyze price action using multi-timeframe analysis. It's better to do it live, right? You can see it happening. I have some, yeah, just draw one of them on a chart. Okay, cool. Look, guys, I've got a few more charts if you want to see them. It's up to you guys. I mean, I can shoot straight over to questions if you like. I don't think, can we have a Fib webinar? Yeah, that's in the pipeline. So someone's asking, can we have a Fib webinar? Yeah, of course we can. That's in the pipeline for sure. And look, guys, any suggestions you have, or any webinars you want us to focus on, please just email marketanalyst@fpmarkets.com. What is your lowest time frame for this analysis? It's always the 1 minute time. Sorry, 1 minute H1 time frame, as you can see here. You can obviously go lower, as I said in the presentation. If you wanted to, if you're an intraday trader or a day trader, you could use the H1 as your higher time frame base, and then nudge down to the M15 or even the M5 time frame to find your trading opportunities. Okay, there's no more questions. I'm just going to spin over to a couple more charts. Let me see if what we had going on. Okay, this was quite a nice one. This was very recent as well. I assume you guys can still see my charts. It didn't actually reach the. Let me just go over that. Okay, so look so we're looking at the Aussie dollar right now. So as you can see in February, we had a shooting star form, right? Again, I wasn't particularly keen on the lower shadow that formed here, but it is a shooting star. And when a shooting star forms on the monthly time frame, just around the underside of a supply zone here at 83.03, 80.82, and a trend line support term resistance, we should pay attention, right? So with this in mind, we know that the sellers could potentially make a run for things. They could potentially take the wheel. And you know, when we had a trend line support break on the daily scale, this almost confirms the bearish intent from the monthly time frame, right? So we've had a trend line support break, and now we have, I believe they are February. This is the February 2nd low at 75.63 in the pipeline, with subsequent selling beyond here to potentially target this demand area here at 74.53, 73.84. Now, with that in mind, we can see on the H4 scale we have a demand and supply currently capping price, so we're forming a range at the moment. Here's another fib level that I drew. This is another projection. So from A to B, pulling that back. So this projects this swing, right? So we've got a 127, I believe it's 127.2% projection formed here. Also note that this demand is fixed above Quasimodo support at 75.92. Now, guys, watch to see if we come back to test this area. A nice whipsaw through this zone into the Quasimodo support could be something to keep an eye out for. Now, what I believe I aired this in previous analysis. So yeah, I did in Monday's analysis. So what I saw here was a trend line support here. Although we had a rough, so I'm talking about this trend line here, guys, this one here. So although we had a brief break here, I believe it was still a good trend line. Although this was the alternative trend line here, resistance, which is, look, guys, this is close to being tested now. And look, we have some confluence there. We have the round number at 77 and the trend line resistance. Also the 100 period SMA close by. So what I did was I noted that we could possibly see a bearish scenario form within this green zone, knowing that we had the monthly time frame possibly seeking lower levels and the daily time frames trend line break with room to possibly move lower to the points here. So knowing that, and at the time we were testing the supply here. So knowing that we were testing supply on the H4, we had possible direction on the daily and monthly scale. I knew that we could possibly see a bearish theme emerge from the 77 region and this trend line resistance here in the green, and we did. Price did drop down. Price gave us, a reasonably, a nearly 80 pip move, but failed to reach the 76 region, which is what I was watching. So now we've broken this trend line resistance. When, as I said, we're now testing this area here. So this, given we're at supply and we have direction on the higher time frames, this could potentially be an area we see sellers make an entrance. Okay, if TA is TA applicable to wild swings based on the speculation? So I have a question here. Is TA applicable to small cap wild swings based on speculation and stock pumps? Well, Jon Snow, I love that name, by the way. Game of Thrones, huh? So yeah, you could even say the same for cryptocurrencies, right? TA for me is applicable to any market. It's how you, I don't know how to really word this, but yeah, I believe personally it is, yeah. I tend to stick away from small cap, wild swinging stocks and things like that. I tend to stick to slower moving markets. I mostly focus on currencies, to be honest, and indices. And they're reasonably slow moving. So yeah, I believe TA is applicable to any market, to be honest. I hope that answers your question, John. Okay, so guys, look, is there any more questions about this analysis that I've just thrown at you? Guys, if I've confused you at all, or please do let me know, and I'll try and go over it in a clearer fashion. But also, just for the fibs, guys, just something I want to add. It was on the previous chart, I believe. So there's also things called. Let me just spin over because this is important. Spin back over to the euro. So for here, this is something called a Fibonacci cluster. Please do look up on this because it's something that can, as you can see, price is reacting here. This is Fibonacci clusters are points where fibs converge at roughly the same area. So here we have the 127.2% projection and the 100% extension. But we could also, I know it doesn't rally up, but if, for instance, we have the, we do. So we have the 61.8% fib retracement nearby, but that converges more with the support. But you can see we've formed a Fibonacci area of support. So basically a fib cluster is where, as I said, fibs converge at the same price point. This is something you should really look into because it can really complement support or resistance, supply and demand, a trend line support or resistance. We're actually breaking the 1900 level now. Brilliant, huh? Excellent. So above here, we're looking at the 1950 range, right? And then we're going to be looking at, which converges with the 1952 resistance seen on the H4. Yes, Ivan, I agree. Trade management often is the difference between a win and a loss. 100%, I agree with that. We're going to be doing some webinars on trade management, trade psychology very soon. Yeah, so please do be on the lookout for that. So guys, look. So have we any questions? Any more questions that relating to the content presented today? If not, is there a recording? Yes, there is. There is a recording that will be available, as I said at the beginning of the webinar. So our support team will email you following the conclusion of this presentation, and you can also view these webinars on FPM's YouTube channel or FPM's website. Where can we contact? So the best email to contact the research team is marketanalyst@fpmarkets.com. This is the best for both to get in contact with me and the research team, and also support have access to this email as well. We would like to see a webinar on the harmonic patterns as well. Thanks. Yep, no problem, Alan. Yeah, so harmonic patterns are something, I would say that's more intermediate analysis, but definitely something that I'll look at employing in the next few webinars. Thanks for that. Any more questions? So I don't think there is. Okay, looks like I've caught up with all the questions. Yeah, so okay, guys. Look, we have tomorrow's webinar to be on the lookout for. This is with my colleague about the stochastics oscillator. This is our first intermediate presentation, so be sure not to miss that. So as always, if there are any specific topics you would like the team to cover, please be sure to send any suggestions again to marketanalyst@fpmarkets.com. Also, make sure to register for the FP Markets Telegram channel to get instant updates. The sign up tab can be found at the lower part of the FP Markets website. One second, I'm just getting a few more questions. Trend line can be drawn on the close as well as the range. Yes, thank you, Ivan. That's a really good point. Yeah, you can draw trend lines in a number of ways, can't you? Really. So we have someone, Ivan, saying trend lines can be drawn on the close as well as the range. So yeah, so you can actually draw trend lines. Where's that? The Aussie dollar chart. So you can actually draw. Here's a good one. Let me just use that. All this one here. The trend lines can actually be drawn with the extremes. The extremes meaning the lows and highs, or you can actually draw. I've seen a lot of traders drawing with the close prices. using the close prices. This, you know, this can actually form a buffer zone for trend line. Oh, on the line chart. Oh, okay, I didn't know that. Oh, you can also use a line chart to draw support and resistance as well, right, Ivan? Yeah. Oh, I thought you was talking about the close prices, because I've seen traders also. Let me just point this out, because I've mentioned it now. So, for instance, if this is the extremes and the low prices are here, you can form a buffer zone for the trend line support. Oh, I'm going off, deviating a little bit. Yeah, thank you for that, Ivan. So yeah, it's a really good point. So you can also use the line charts for. Let me just spin that over. Actually, line charts to form support and resistance, right? So it can make it a lot clearer to view the support and resistance without all the extremes, because line charts are formed on closing prices, not like the candles that have the highs and lows and some wild price action in between. So look, you can spin over to the line chart and we get a clearer view. So we can find the support and resistance here, for instance, resistance, and support. It just helps, especially, it's a really good point actually, because that can help newer traders focus in on support and resistance levels. Okay, guys, look, thank you all so much for taking the time out of your day to attend the presentation. It was really great seeing some familiar faces here. I really hope some newer traders took something away from it. Unfortunately, I think that's all we've got time for today. Thank you all so much for joining. Have a great day, and I'll see you again real soon. Thank you very much.